It's the spring buying season, and in years past, this was the perfect time to look for a dream home. But today, for the third year in a row, that dream has turned into a nightmare. We thought we were seeing some relief in the housing market, but just as prices were starting to come down, things turned once again, heating up rapidly, angering buyers and enriching sellers. Bidding wars, packed open houses, and absurd seller demands are once again the norm. Look at the comments under every single one of my recent videos, and it's filled with buyers struggling to navigate this absurd situation. The crash that was on the horizon, the one everyone saw coming, is now a distant dream for millions of buyers ready to make the single biggest purchase of their lives. The common belief has changed, and now everyone is all in on the great recovery, with prices once again pushing upwards. But this new idea of a surprise recovery might just be a massive illusion, one last breath of hope before everything comes down. Today, there is emerging new evidence that suggests a serious downturn in prices following the summer. A quick glance at recent developments showcases exactly this. To fully understand these details and why I believe the crash is coming despite this recent bullishness, look no further than D.R. Horton. This single company is the biggest home builder in the United States, and it's publicly traded, which means every quarter we receive insights that can provide valuable information regarding the pulse of the market. D.R. Horton just released its Q2 earnings this past week, and the stock price rallied on the update. You might be thinking that this goes against what I just claimed, but it's not what you think. It is true that in a shocking development, Horton stock is just a few dollars beneath its all-time highs. In fact, since bottoming out last summer, just as housing values began to turn down, Horton stock, along with nearly every other major US builder, rallied more than 75% as the rest of the market remained mostly flat. So with that said, how can you possibly believe that a crash is coming if home builders including D.R. Horton are thriving with their respective stock prices nearing all-time highs? Well, this is where the disturbing details unfold and the supposed recovery thesis that has been gaining popularity in recent weeks breaks down. You see, the housing market in its most basic form is like every other market on earth, the outcome of supply and demand. And right now, the entire recovery is based on one side of this equation, supply. Examining every known piece of data available to us proves that there is no evidence whatsoever that housing demand is improving. We can start with new home sales. In the last two crashes, we can see that this indicator in both instances provided sustained readings of year-over-year decline. Today, home sales are down 18% compared to numbers in 2022, and while the year-over-year number did fall to minus 32% earlier, it hasn't yet showed any major signs of improvement. Home sales are still down bad, and as you will see later in this video, major home builders aren't really betting on a recovery either, despite their stock gains. We can also take a look at the best real-time indicator of housing demand in finance, the New Purchase Mortgage Application Index. Since 1990, this figure has been a leading indicator of housing activity, and it's currently at levels on par with the Great Crash of 2008. Since peaking in 2020, the index has seen a decline of about 54%. This is very similar to the type of decline we witnessed in 2008. This Yardeni Research piece shows that typically when we see purchase applications collapse, home sales tend to follow, and when sales collapse, so do values. In this highlighted region right here, national values, according to the Case-Shiller, collapsed 27% from peak to bottom. But in today's similar conditions, we have only seen a 5% decline thus far. And this is because we have a supply issue in the market. The demand is not there. There is no recovery. If there was a real recovery, we would see the signs with home application data, home sales improving, and buyer sentiment jumping, yet none of that is happening. So once again, let me repeat it, there is no recovery. This value improvement we're seeing is simply a result of seasonality combined with historically low inventory. And while some like to say that existing sales have already bottomed, which could be true, keep in mind that most of the time there are two different bottoms. Bill McBride has outlined this many times. In a recent article, he famously stated there will be two bottoms for the housing market, one for activity and the other for prices. Existing home sales may have already bottomed, but we will see further declines in residential investment. Prices, especially in real terms, will be under pressure for some time. So why the massive jump in home builder stocks? How can I possibly claim that the crash is coming but provide no explanation why builder stocks are flourishing? Well, that has to do more with the bizarre reality that is today's market. You see, because nobody wants to sell their house, the existing home sale market is getting very competitive. In many markets, the difference in monthly payment for new homes versus existing homes is actually rather small. Homebuilders like D.R. Horton have realized this quickly, and unlike private sellers, national homebuilders are incredibly quick to adapt to a changing market. What they have done is simple and genius. They created these incentives called mortgage rate buydowns that allow you to purchase a home for a 30-year fixed rate well below the current market rate. This practice is prevalent throughout the industry, with almost all major builders offering these types of incentives. Take for example D.R. Horton. You can buy a home with them today for as little as 5% down, and they'll make your year 1 interest rate 2.99%, going up to 4% in year 2 and 5% for the rest of the years. This means you can lock in that 3% rate, and maybe 1 or 2 years down the road, you can simply refinance if rates go down as many predict. And if not, you're still getting a great deal at 5%, considering that the market rate is nearly 2% higher. To show you the power of this incentive, take this simple example. But before I reveal it, take a moment to hit that like and subscribe button if you're enjoying my video. My last upload got over 4,500 likes, missing that elusive 5K figure by just a few hundred. It would mean a lot if we can get there for this video. Now back to the example. In my local Cleveland neighborhood, a standard house built in the 1960s goes for as much as $260,000. At current market rates and 10% down, you would be paying around $2,050 a month for this home. At the same time, a new build with a nicer layout, more square footage, and modern features would cost you around $350,000. But using that rate buydown, your payments in the first year would literally be the same exact amount as the existing home built in the 1960s. So for many people who are looking to buy today, going with a builder is a no-brainer despite new homes being more expensive. This has caused builders to take over the overall residential market. Previously, they only made up around 9% of all sales. This number is now upwards of 30%, meaning that while before 1 in 10 buyers were going with new builds, today almost 1 in 3 are. So in summary, despite demand falling off a cliff, companies like D.R. Horton were able to grab market share in these unique circumstances by offering these wild incentives that are essentially allowing people to bypass extremely high interest rates. Home builders were operating with massive margins before, making record-breaking profits on each sale. Now they've realized that instead of cutting prices massively or allowing sales to dry up, they are simply offering these rate buydowns, which are rumored to cost them $10,000 to $12,000 per transaction. By doing so, builders can maintain volume and grab market share. You can see this by examining the specifics of the earnings release that, strictly financially speaking, proves that D.R. Horton is not doing that well. Net income per share decreased 32% year over year, with net income decreasing 34%. Sure, Wall Street loved the revenue and sales figures the company posted, but the bottom line is that Horton, along with many other builders, are now forced to dig into their own margins to keep home sales going. And this video isn't meant to trash the builders. I think what they're doing is brilliant business-wise. If I was a buyer in today's market, I would 100% be taking advantage of these spectacular offers, but the stock price isn't really indicative of what's really going on. At the end of the day, builders are finding it harder and harder to keep their fat margins going, and many like Horton are now forced to reduce their profits in order to incentivize activity. If the Fed doesn't capitulate and begin easing, home builders will eventually be forced to reduce prices as well. In fact, if you look at new construction permits, you can see that builders don't really believe in the future of this market. New single-family construction permits are down from the peak, and builders are acting cautiously moving forward. If things were as rosy as the stock price indicates, you would see this chart explode towards the upside. Why not build to the maximum if the belief is that the recovery has started? Not even the builders believe this, and this chart essentially proves it. Today, what we have is too many people chasing too few homes. This has created a massive supply problem that is essentially keeping this market alive. If we turn to the future, we can see that with rates continuing to move above 6% and inventory building for the summer, there is going to be significant pressure on prices. Bill McBride, who I consider one of the best, if not the best, housing analyst in the world, has stated that we will likely see a sharp increase in completed inventory over the next several months, and with a near record in units under construction, the supply situation is looking like it's going to rapidly change following the spring selling season. Ultimately, if the recession fears continue, unemployment ticks up, and Powell continues tightening, something will have to break. The demand side is already done. Now we're just waiting for the catalyst that will bloat the inventory situation. When the spark finds the fuel, this wild market bubble will come to a spectacular end. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed the video, and make sure you drop a comment below if you took advantage of these new build incentives in recent months.